yeah, let's just go ahead and hop into it. So just a quick general overview. Supply and demand is pretty much the only thing that moves the markets. It really is how everything moves. I mean, price does adjust to, willing buyers and sellers, and on a price chart, you can pretty much figure out where all the unfilled orders are. You can get a pretty good idea, and that's where we look to trade from, is areas of price where we think there are unfilled orders left. And one more thing, supply and demand is a lot more precise than order blocks or clusters or boxes, whatever you want to call them, just because it really goes into a lot more detail than I've seen like the order blocks go into, for instance, and it really just tells the story of the price action a lot better. Let me just go ahead and get into the basics. So the only thing that moves price is buyers, which is demand, and sellers, which is supply. When supply and demand are in balance, price is consolidating. It is only when there is an imbalance between buyers and sellers that we see a change in price. Price moves higher from levels where demand exceeds supply. Price moves lower from levels where there is more supply, so supply exceeds demand. Price moves from supply zone to demand zone and vice versa. We look to trade from the origin of impulse moves because that is where supply and demand are the most out of balance. So demand, you want to be buying. It's bullish because more buyers than sellers at that level, and you can tell by the reaction away from the zone. And there are more, or you want to be selling at supply, and it's bearish because there's more sellers than buyers. And the supply and demand zone is confirmed once price moves away from the base. There are naturally unfilled orders at these bases, so when price returns, you can expect the unfilled orders to be triggered, cause a reaction in price. So that's the whole key of this. We're looking for areas on the price chart where we think there are unfilled orders. So identifying supply and demand zones. So looking down, if you're looking for demand zones, you want to look down and to the left. And basically you want to look at the down candles or the consolidation at the origin of a breakout or impulse move to the upside. And I'd like to mention that you might have already noticed how I write breakout / impulse move to the upside, and that's just because some people say breakout and they mean like a breakout to the downside, which I just call that a breakdown. So if you are ever wondering why I always put both, like impulse move and breakout, is just to clarify that. So really you want to see large green candles leave from that level, and that's basically a demand zone. And it's the opposite for a supply zone. You want to look to the left and above price, and you want to look at the up candles or the consolidation at the origin of a breakdown or impulse move to the downside, and you want to see large red candles leave from this level. So whenever we're looking to mark out a supply and demand zone, we want to be looking at fresh zones where there's fresh orders. So when you're choosing a zone, one of the most important factors is choosing a fresh zone. This means that it's not been tested yet. Every touch of a supply and demand zone consumes orders. This gives you a less probable chance of price bouncing from the zone. Once all orders have been consumed from the zone, price will break through. This is why we look to trade the first time back, because you're getting those fresh orders. So if you want to imagine it this way, this is just something I'm trying to think of off the top of my head. There's probably a better example out there, but imagine a supply and demand zone as like a tree, like a tree you're trying to cut down or something. The first time you hit it with the axe, it's gonna hold pretty firm. It's not gonna affect it too much, and it's definitely not breaking on that first chance or on that first that first chop or whatever. But like the more you hit it over time, the thinner the tree gets, and eventually you'll get a point, or you get to a point that is so thin, and the next time you hit it, it's going to fall down, and the axe will basically break through, and the tree is going to fall. So you can kind of think of it as the same for a supply and demand zone. They're basically filled with buy or sell orders, and the more time price hits the zone, the thinner it's going to get, until eventually all of the orders run out and price breaks through. So it's kind of just off the top analogy, but I hope that helped a little bit. So whenever you're marking supply and demand zones, you want to mark out the highest and lowest candle close, which is basically the base before a breakout or a breakdown. So what I like to do, as you can see here, I have this down move before the up move. I marked out the highest candle close, which I guess this is the close, this is the open, but I just mark out the down candles. And you can see I did the same thing on the bottom. And there are wicks on both sides, small wicks in this case, but I don't usually mark the wicks. I know some supply and demand traders do mark the wicks, but I don't mark them just to keep it clean, and you usually get a reaction from the candle body itself. At least that's what I found. But you do want to take in the wicks into consideration. Like, they still are part of the zone. I just choose not to mark them out, but they are you still have to consider them. So you can see as the same thing as for demand and supply, you want to mark out the highest and lowest candle close to form the base at the origin of a breakout or origin of a breakdown. And I just like to use a horizontal box. My candles are blue and orange, so I use a blue box for demand, orange for supply. You know, you can do whatever color you like. It literally doesn't matter. But and another thing, whenever I'm marking supply and demand zones, is it's always nice to just have a supply zone above price and a demand zone below price that you think you think it's likely gonna head in either one of those directions, and you'll be prepared to trade from one of them. And it just gives you a good gauge on where you think price is going and where it's headed from. So next is the supply and demand structures. So we have bullish and bearish structures. So the bullish or demand structures, you have a drop base rally, a DBR, which is a reversal pattern. And I have examples for all of these on the next slide, so you'll be able to see them. And the other bullish or demand structure is a rally base rally, which is a continuation pattern, and it's the opposite for supply zones. You have a rally base drop, which is a reversal pattern, and you have a drop base drop, a continuation pattern. So let's go ahead and take a look at the examples. So here's a bullish or a demand structure. It's the drop base rally, and it's a reversal. You can see we have a drop in price, a base, and a rally. It's the same structure right here. We have the drop, the base, and the rally. We marked out the highest close up here and the lowest close down here. And you can see once price retested it, it went higher. So if you would have bought in this demand zone, you would have had a nice trade. And something I like to see as confirmation that price wants to go higher. You can see this is on the second attempt. It did tap right here and move higher temporarily and came back down. But what I like to see is once price tests the demand or a supply zone, it holds above it on the close. So you could see opened up here, came down, tested it, closed back above the zone, opened up and went higher. And you can see that was a great trade if you would have longed that. So that is the drop base rally. That is a reversal, as you can see. And next we have a rally base rally, and this is a continuation pattern. So basically you have a rally, a base, a rally, just like it sounds. Here's that same area of price. You have a rally, a base, a rally. Once retested, price chops up and goes way higher. You might notice this price action right here from the Bitcoin daily chart. This is pretty much what started the bull market in April 2nd. But you know, that's besides the point right now. So those are the two bullish supply and demand structures. We have a drop base rally, which is a reversal, drop base rally. Then we have a rally base rally continuation pattern, a rally base rally. So getting into the bearish or the supply structures, we have a rally base drop, which is a reversal. We have a rally, a base, and a drop. You see the same area of price over here. We have a rally, a base, a drop, and once retested, offered you a perfect short opportunity, and look what price did. It rejected. So that's a rally base drop, and that's the reversal. Now we have a drop base drop continuation pattern. We have a drop, a base, a drop, Same area of price over here. Drop, a base, a drop. You see this tiny little candle. Look how precise that is. I mean, that would have gave you the best entry possible on this. So really, these continuation patterns just allow you to get in on a trending market, more or less. This is the downtrend. Retest of this supply zone. This drop, base, drop continues to the downside. So continuation patterns, the drop, base, drop, and the rally, base, rally, just let you get in on trending markets, basically. Another key thing to look at is compression. It is very important. It's basically looking at absorbed orders and consumed orders, all of that. So in the bullish case, the bullish compression zone is where supply is being absorbed, right? So price is falling. So imagine price is falling while spiking north. It's falling to find key demand so it can reverse. But at the same time, while it's falling down, right, it's spiking north. So if all this sounds confusing, I have examples on the next slide to, get you or help you understand it a little bit better. But basically, it's falling to find a key demand zone so it can reverse. But while it's doing that, it's also spiking north. And when it's spiking north, that's doing pretty much two things. It's testing lower time frame supply zones to give it enough selling momentum so it can get to that key demand zone on a higher time frame to reverse price, reverse the trend. And also, while it's spiking north, it's consuming all the demand. That should be actually supply. I don't know why it says demand. So this should be supply right here, spiking north to consume supply to clear upside path. So basically, it's consuming the supply above price. That way, whenever price does hit that key demand zone, high time frame key demand zone, it has basically a clear path to move to the upside with no resistance stopping it. No supply left to stop price or reverse it. It's opposite for the bearish compression zone. It's where demand is being absorbed. Its price is rising while spiking south. So basically, it's rising to find a key high time frame supply zone to reverse the trend. And while it's rising, it's also spiking south, which is testing demand so it can get enough buys and bullish momentum to reach up to that key supply zone. And also, while it's spiking south, it's consuming demand. So whenever it does hit that key supply zone, it is free to move lower with little to no support that will hold it up. No demand, no fresh demand to hold it price up, so it can just rip through. So let's go ahead and look at the examples. I was like, what happened to my examples? I think I have them right here. So I have two different examples here. This first one shows compression, bullish and bearish compression, consuming supply and demand, and I'll show you what I mean by that. If you notice, this is from March 2nd, so it's a pretty old example, but it's a great example of how compression works. So let's start off at the beginning, right? Here's the origin of a huge impulse move, breaks market structure. So this is a demand zone right here. And you can see on this retest, you want to be buying. And that's pretty much how it goes. But let's see. So price is making higher lows. Here's a key high time frame supply zone. So it's pretty much consuming buyers or demand all the way up to the supply zone. You notice here's a key, or here's a demand zone, consumes it right here. Here's a new demand zone, consumes it right here. A new demand zone. You see these are just the origin of these impulse moves. Consumes it right here and then goes higher. So that's consuming all of the demand. There's no fresh demand left. So once price hits this high time frame supply zone, it pretty much is able to drop and without anything holding it up. So you can see right here I have prices also consuming buyers here while rising higher lows towards high time frame supply. Once the buyers have been consumed, price can fall through with no support stopping it. This explains the violent drop to the right as there is no demand left to hold it up. So you can see once price tapped into this high time frame supply zone, it is violent drop, and basically look where it landed, or look where it finished off at. You can see this is the very beginning of this whole compression zone, and it basically took out that compression zone. And so the same thing on lower time frame was happening right here, but it was consuming supply, so buyers could freely move higher. So you can see this example would have been better on a lower time frame for this area, but I had it all on one chart. So here's a supply zone, the origin of a sell-off, right? Price retest it, so there's no supply left right here. It goes a little bit lower, comes back up. Here's a origin of a sell-off. Price comes back up, retests this supply zone, consumes that supply. There's no supply left. Here's the origin of a sell-off. Price comes back up, retests the supply zone, consumes the supply. There's no supply left here. And breaks down, forms a supply zone, goes lower. Price retests it, consumes the supply zone. There's no more supply. So what does price do? It's able to shoot up and break through this compression. You can see it kind of paused right here and went higher, but basically took out this whole compression zone right here because there was no supply. I wrote down, notice how price is consuming sellers. Once the sellers have been consumed, price can freely move up with no resistance. So the same thing happened right here. See, like I said, this would have been a lot better on lower time frame because these moves don't look like much, but here's a origin of a sell-off. Price retest it and goes lower. Here's an origin of a sell-off. Price retest it right here and goes lower. So there's no supply left. Price is able to shoot up and pump basically with nothing stopping it. So same thing happened right here. A low time frame supply zone. Price drops, retest it, takes out that and consumes that supply. Price goes, forms another supply zone, drops, price retests it, consumes that supply. So there's no supply left to this whole zone. There's no fresh supply. Price is able to just shoot up and break through it all. Finally get up to this high time frame supply. Once it does, like I said, it consolidates for a bit and drops very violently and takes out this whole compression zone because there is no fresh demand or buyers to hold up price. So I hope that was alright, and I hope you can understand that, because compression and just absorption and knowing when all of the buyers or sellers or demand and supply is consumed at a zone is very useful, because in this example it's just perfect. You can see once supply was consumed, price is able to pump through it all. If you're trading low time frame, this could be very well for scalping, and once all this demand was consumed, price was able to just shoot past it. So let's go ahead and look at the next compression example. So here we have compression up to another key high time frame supply zone. You can see there's really no fresh demand zone. I don't have this isn't a live chart, so I can't mark anything up, but you can see there's really no demand zones here. There is a little bit right here. Price shoots up, breaks this market structure, but it's not a very strong supply or a demand zone. Price breaks it, taps into this area right here, gets a little bit higher, you can see this wick taps into this zone just a little bit, goes higher, breaks down, price consolidates a little bit. This is a down candle. This would have been in demand zone. Not a very strong demand zone, give it that, but low time frame, it probably is a demand zone because it's the origin of this small little impulse. Price consolidates, wicks down, takes out these buyers basically, and you'll notice, look, all of these wicks are pushing down and buyers are getting consumed. It's pushing it back up, so it's taking out a lot of buyers every time it wicks down and pushes back up. Wicks down, pushes back up, wicks down here, pushes back up. Price absorbs demand on the way up and clears the way down. So price consolidates. This is just choppiness, really. It does finally pump. You can see this is a demand zone. Pushed it higher on retest perfectly into the zone, consumes it. Price goes a little bit higher, gets enough bullish momentum, taps into that high time frame supply zone, and then with no demand left, price is free to fall through the compression with little to no support stopping it. And you can see this is the origin of that whole compression zone. Price dumps straight to it, takes it out, and then consolidates, does whatever it does. But notice how on both of these examples, the origin of the compression zone, price just goes and fills that whole move in. Same thing here. Origin of compression, this drop basically takes out that whole compression zone. So let's go ahead and hop back into the slides. I hope that compression example was clear enough. So there are a few odds enhancers, and I want to go over this probability score. Odds enhancers are really the key to know, or like for knowing what zones to trade from. You know, what's the probability that price is actually going to bounce from that zone, and it really just helps you find which zones are significant. So the first odds enhancer, how did price leave the level? The stronger the move away from the level, the more out of balance supply and demand are. And you'll notice these numbers at the end of each of these odds enhancers, and I'll explain that on the next slide. But basically, well, I mean, I guess I can explain it now. How did price leave the level? So here I have these two examples. These are from Sam Seiden. That's who I originally learned these odds enhancers from, but he doesn't really go into too much detail with them. He does a little bit, but I have added a few of my own that I've found that helps add probability to your supply and demand zones. So how did price leave the level? The stronger the move away from a level, the more out of balance supply and demand is. So you can see this is the best reaction away from the level. You can see we had a strong impulse move. Here you have a gap. You don't really get gaps in crypto like that, but you can see we had a strong move, which is you would give it a 2 on the probability score. You see we had this is, I guess you would say this is a good example. You know, a weaker but still a strong move away. And you give that a 1, and then you have a poor move away. Just choppy, really no impulse move, just a kind of grinding upwards or grinding downwards. This is honestly like a compression zone. So you don't want to trade from origins of moves like this, because it clearly shows that buyers, in this demand example, buyers were barely exceeding sellers. The demand was barely exceeding supply. So there's not, you wouldn't expect very many unfilled orders to remain there, because price consolidated for so long and didn't really break away from that zone that orders could have got filled on that easily. So the second one, how much time did price spend at the level? The less time price spent at this level, the more out of balance supply and demand are. I have this example here, how much time did price spend at the level? So you can see if we have this supply zone up here, the less time price spends at a level, the more out of balance supply and demand is. So you can see this best example, which is a 2. Price doesn't stay there very long. It comes up, forms a base. This is a rally base drop. You can see basically a fast reaction. So you pretty much know that supply and demand is out of balance there, and you'll want to look to trade from these best examples. A 2 on the probability score. You see on the 1, on a good reaction or a good amount of time spent, just a short amount of time. And then on this poor example, you can see that price consolidates for so long that likely all of the orders have got filled because it stayed there for so long. See on these, price really reacts to it very quickly and gives you no time to get filled on any orders. So I hope that's clear. How far did price move away from the level before returning? This is basically your profit margin or your RR. The farther price moves away, the more reward available. So that's pretty self-explanatory. You know, the farther price moves away from the zone, the more profit that is available for you if you're, trading that from that zone. It's also a 0 through 2 on the probability score. You can give it each of these ratings. So number 4, the fourth odds enhancer. Did price break a key level when leaving the zone? If price breaks a key level that adds significance to the zone, enough buying and selling at that zone to break a key level. So it's 0 or 1. 0 meaning it did not break a key level, 1 meaning it did. So this is something I found that really helps your odds and just finding which zones are significant and which ones you want to trade from. If there's enough buying or selling at that level to break a different key level, whether that be a other supply or demand zone, a high time frame level, support and resistance, whatever. If there's enough buying and selling at that zone to break one of those levels, on a retest of that zone, you want to take that trade because, I mean, clearly there's way more buyers or sellers depending on demand or supply. But, you know, that's something I found that has really helped me when picking which zone to trade from is number 4 right here. And then number 5 on the odds enhancers list is levels on top of levels. Multiple levels on top of each other offer you more protection. So that's pretty self-explanatory too. If you have 2 levels, let's see if I can do this. Okay, yeah, we'll just run with that. So say you have a, let's see. So say you have a drop, a base, a drop, a base, another drop, right? If you take a short from this supply zone right here, you could place your stop above this supply zone. So that way you're getting 2 levels of protection. So if price comes up here, you know, well, hold on, let me do, so let's say, for example, price is retesting, right? Forms a demand zone here. Test this. So this is your entry, right? If you're short from the supply zone, comes back down, test this demand, which makes price go higher. If it comes back to this supply zone and then dumps because this demand got consumed on this retest, this supply got consumed on this retest, that's why price went higher and broke through that zone. Now this is the only fresh zone left. You have your stop above that and price finally reversed. So that's just levels on top of levels, obviously add more protection. The opposite is true for a demand zone. So let's go ahead and just clear that off. So how do I exit off this? Let's see. Alright, so that's it for the odds enhancers. Those were the 2 examples. I don't have examples for the other, 3, 4, and 5, but they should be self-explanatory. And let's go ahead and get into the probability score. So after going through the odds enhancers checklist, you want to do that every single time you go to mark out a supply or demand zone. And after a while, you will basically have it be like a subconscious thing. That's how it is for me nowadays. I don't really go through that list anymore because I have it all memorized in my head. I mean, the instant I see it, I know, and I don't even have to mention it. It's just kind of subconsciously. So after you get enough screen time and enough time watching all these supply and demand zones form and just knowing which ones to trade from, it'll become, a lot easier, and you won't have to go through that checklist every time. But once you go through that checklist, you'll have a probability score assigned to the supply and demand zone. The higher the score the zone has, the higher probability that price will bounce from and head towards your target. I meant to put bounce from that zone. But a perfect score would be an 8. You see you have 2, 4, 6, 7, 8. If those all got perfect scores. A good score is 5 through 8. Anything below a 5 is not worth trading. So say you have on first one, how did price leave the level? Let's just go ahead and draw up another example. So say you have a drop, base, rally, right? Hold on, let me back that up. You have a drop, base, and then you have a rally. A really shitty rally. So this would be a 0. So you get a big fat 0 for that. So how much time did price spend at the level? So you have a supply zone, you have a drop, a base and a drop. You can see price has consolidated for a long time. So how much time did price spend at the level? Way too long. So you can expect all of the orders to have been filled because of how long price stayed there. So on a retest, you might get a small reaction and then it would probably break that zone and go higher. So that'd be another 0. So you could see if you have low scores on these, then the probability of your trade working out is going to be very low. Let's see. So I think that's good on those examples. Man, sorry, I don't know how to exit the same. So how price approaches a zone is pretty important as well. It can really increase or decrease the odds of your trade or how price is going to bounce. We want to see a rounded retest or compression on the retrace to the zone. V-shaped reversals decrease the odds of price bouncing. So as we talked about, how compression up to a high time frame supply zone or down to a high time frame demand zone will give you higher probability of price bouncing and going towards your target because there is not any fresh demand or supply above or below price to stop it. So I'll go ahead and give some examples of these. So say you have a demand zone, right? This is a demand zone. That's really shitty. Hold on. Sorry about this. All right, we're dealing with that, right? So what we want to see is a rounded retest. So that's another really shitty example. Sorry, I suck at drawing with this, but that is pretty much a rounded retest. And if you are familiar with my OTE supply and demand setup, this is pretty much it. Breaks a key high, stops, build up under these lows. This is the OTE. You take it from the low to the high or the high to the low, whatever, and price bounces. But so that's a rounded retest, so that's good. And compression, say you have a demand zone, if price is compressing, so this is just basically falling while spiking north, consuming all of the supply and getting enough selling momentum to come down and test this high time frame demand. So all of the supply is getting consumed. So once price retests it, it's able to move and go higher and break through all of that compression. What we don't want to see is a demand zone price break out and immediately retest it like that with a V-shaped reversal. That usually results in the demand or supply zone failing. This is just what I found has worked and what has not worked from trading it for a while now. So you basically want a rounded retest, compression, and you do not want a V-shaped reversal. It's basically will decrease the odds of price bouncing. And let's see. So also ledges. This is something I do not see. I don't know what's up with this slide. I guess I did not write everything down for some reason. I think it's just a duplicate of this. So I apologize for that. But ledges is something I don't see people talking about very often. But it's basically when a new supply demand zone forms. Like, okay, so let's go ahead and mark this out. It's basically like a mini zone that forms on the way to test one of your key supply demand zones. So say you have a supply zone, price drops, it's coming back up. Hold on, actually, let me read that. Price drops from a supply zone, coming back up, forms a demand zone, right? This would be a ledge. So it's basically something that can hold price up. So on the way up, you short this, right? Your entry's here at the supply zone. Your stop can be here or above a different level. But once price comes back and tests this demand, what you'll see is price could come back up, and if there's still a lot of unfilled orders at this supply zone. Could set a lower high here, show weakness and go lower. But you have to be aware of these ledges, because if price came up here, say for example price came up here and consolidated for a while before dropping and retesting this, it could consume all of the unfilled orders here. So on the retest of this, I'm sorry for this really messy drawing here, let's just so this is the first option, right? You have this ledge, price quickly rejects from the supply zone, retest this demand, which is a ledge, comes back up, shows weakness, and there's still unfilled orders here, gets filled and goes lower. So the other option would be price breaks, forms this ledge, comes back up. Here's your entry, like we said the first time, but price can consolidates for a while, fills all of these orders, comes back down to test this demand or a ledge. And since all of these orders got filled up here, price consolidated for a good amount of time, it's free to move higher. So this is why you have to be aware of these ledges. So you don't want to get stuck in a trade with a key ledge or demand zone right here. But one thing that can happen, and what you want to happen, is this right here. Pretty much what's happening is you're consuming this demand, right? Consuming this demand, so whenever it basically on this retest, if it comes back down here and tests it again, this will already be consumed, especially considering that this demand zone, this ledge, does not break this zone. So it's really not breaking market structure. So it's not that important. The real key is knowing if all of these orders are going to be filled or not. So I hope that makes sense, and I apologize for not having this, all the notes on here. I don't know how that happened, but so that's about it for the basic information. Let's go ahead and hop into the entries, the stops, and the targets, and how to trade them. So entry for a demand zone, you can place a limit at the top of the zone. There's two options for this, really. You can place a limit order at the top of the zone. And really, this depends on your strategy already. I wouldn't change it if you already are used to limiting in, or if you are used to market buying in, market selling in. I would just go with what you're used to and what you have stats to back up. But excuse me, yeah, so you can place a limit buy at the top of the zone. So say you have a drop, base, rally, this is demand. You can have orders sitting here, and I don't do this, but this is something you could do. You could because say price did come back down here and it didn't just bounce off the top of the zone, right? You could get a better entry if you stack your buys in, right? So say you did 50% here, 50% here. That way you get a better average entry. If it does dip farther into the demand zone, that's up to you. You can decide if you want to do that or not. I don't personally do that, but yeah. And the other option is market buying once price has tested the zone and closed outside of it. So you'll have this demand zone, right? Typically, if price taps into the zone and you get a wick, but it closes back up here, right? So it's just basically, this is how the candle body would be, more or less. It wicks down here but closes back above the zone. I have it mentioned down here. If price taps into a zone and closes outside of it, then that is typically confirmation that price wants to reverse. And you guys know, hopefully by now, that candle closes are a huge part of my trading, and it really helps for confirmation. So you could market buy on the close of this candle, and the opposite is true for supply. You can basically have a rally, base, drop. You can have sell orders here for on the retest, You get filled with your limit sells, or you can market buy if price comes up, test it, and closes outside the zone. This is a terrible example, I'm sorry. Something like that, right? You can market sell as soon as that candle closes. And we only look to trade from these zones on the first time back. And the reason that is because, like I said, once price taps into a supply demand zone, it consumes orders. So trading on the first time back gives you the highest probability and the best chance of a winning trade. So that's it for entries. It's pretty simple. There's not a whole lot of different ways to go about it. I personally like to wait. I don't like to place limit orders because, especially in crypto, you never know, because price can just rip through one of these supply demand zones. As much as it can be a key zone, it can get a perfect score in the odds enhancers, price can still just rip through it. Doesn't happen that often, but if it does, you don't want to just get filled and stopped out on the same candle. In my opinion, that's just, I don't know, I don't like doing that. So I like to market buy once price has tested the zone and closed outside of it. That's typically the way I go. But yeah, that's pretty much it for the entry. Stop loss placement. Here are a few different options for your stop losses. So you can place your stop above the supply zone or below the demand zone. So if you have a drop, base, drop, supply zone, here's your entry. You can place your stop above here. Typically, if you have a key zone with a lot of significance, that will work out fine. The opposite for rally, base, rally, demand zone. You can place your entry here, your stop below here. And as far as the wicks, because I don't know, I think I said this already, I only mark out the candle body, but you have to take the wicks into consideration because it still is part of the zone. You just have to, I just like to mark the candle bodies to keep it cleaner, and that's typically where price reacts to. But so in these examples, if you have wicks down here, place it below the wick. Unless you have crazy wicks, like imagine this wick was like this, and this one was like this. If you have really, really long wicks, you can most of the time just place it behind the zone, like this. But if you have smaller wicks, I would just place it above the wicks, just in case, and give you more protection and more, just clarification that you're outside the whole zone. So the second option is behind the next supply or demand zone or a high time frame level where price could basically turn around at. This will offer lower risk to reward, but more protection, and can allow you to exit early if there are signs of failure. So examples of this, I'm going to get rid of these. So say, we had that example earlier, a drop, a base, a drop, and then another base and a drop. So these are two supply zones. If your entry is here, say price comes up, forms a demand zone, a ledge, fills your order, but comes back down to test this demand. If this is going to break, if there are not many unfilled orders anymore, all of the orders got filled, all of the cells are consumed, price may break through it from this ledge or demand zone, and you are protected by this second supply zone if your stop is up here. So that'll offer you a lower RR trade, but you have more protection. And say on this rally up here that broke this, if price closes above the zone, if this isn't just a wick, if price closes above the zone right here, you can exit here for a small loss, because if it closes above the zone, it's typically a sign that it's going to go higher. It's basically breaking this high, closing above this high, shifting market structure. Because if you look at this now, you have a low, a high, higher low, higher high, it broke this high, a higher low, broke this high on this higher high and now a higher low that could form on this zone. It might flip, or one of this, like here, basically this would be a demand zone now. Sorry, this is really messy, but I hope you can understand what I'm trying to draw here. So, you know, this second option does give you the chance to exit early at a smaller loss and not take that full R or 1R loss. So, you know, those are just two options with their stop losses. And for all of my different options I give you guys, I would definitely test all of these yourself. You can go back through the chart, find supply and demand zones, see what price typically does at these zones. If it does just react to the candle bodies, if it does react to the wicks, if it typically breaks zones and you need double protection by these two different zones, you know, always test these things for yourself, because as much as I traded supply and demand or traded ranges like my other video, you know, I'm not perfect and I definitely am not winning every single trade all of the time. So, you know, just test these for yourself, find what works best for you. You know, everybody's different, everybody likes different things. So that's it on stop loss placement. So there are multiple ways to find targets, and really all of these options work. It really, like I said, just comes down to what you like to do. If you are more risk adverse, or if you are more risky, if you like to try to get bigger wins, or if you prefer to just, you know, bag 1R trades, try to get a 1R trade every day, or whatever it is, you know, you're just going to want to experiment with targets yourself. So there are multiple ways to find targets. If you're short, where's the next demand zone that could reverse price and change the trend? So if you are short from, again, this example, you have a drop, a base, a drop. Price comes back up, fills you on this. Stop above here. So is this a demand zone right here that price could reverse from? Or is this just a reaction from a different zone? And really the key, you know, the key demand zone is back here. Maybe that was the origin of that big move. This would be your target area then. If this is the key demand zone, if you're short from this area, from this supply zone, this would be your target. So this is the next demand zone that probably broke market structure, has high probability score, and this is where price could reverse and, you know, change the trend possibly. So the opposite is true if you're long. If you're long, where is the next supply zone that could reverse price and change the trend? So you have a drop, a base. That's terrible. A drop, a base, a rally. Here's your demand zone. You get in right here on the retest. Say it's compression. You get filled on that. That's a, you know, ignore that circle. You get filled right here. Price goes higher. Maybe this is the origin of that move. This is a supply zone. This is the next supply zone that could reverse price and change the temporary trend. So really, you just have to look and find key supply and demand zones. That's why you want to mark out a key demand zone below price and a key supply zone above price. You can always know where your next target or next entry is going to be, and you'll just know where price is at, where it's gravitating towards. If it needs more supply or needs more demand, you'll know where those zones are and where price is likely reaching to. So, you know, that's the first example of your target options. You can target a high time frame level, whether that be daily, weekly, monthly, you know, any higher time frame level, whether that's support, resistance, SR flip, whatever. Option 3 is you can take profit at the first trouble area. So what that is say you have a drop, a base, a rally, right? Price comes back down, you get filled here. This could be your first trouble area. There might be a supply zone right here, a lower time frame supply zone, but typically this could be your first trouble area. It's just that first high. So you might want to bag a 1 or 2 hour trade right there. That's the first trouble area. I'm sure you've heard of that, and there are many examples online. I think you can find one somewhere, I'm sure. And the last is a measured move. This is something I don't see anybody talking about. I've actually never seen somebody talk about this with supply and demand. But it's something I use pretty much every single time I'm looking to trade from a zone, or just in general look at supply and demand zones. So basically a measured move. This allows you to get an idea of how far price will go from a zone. So say you have a demand zone, and that is the move, right? That is the move away from the zone. So typically you can take a measured move. Say this is a 10% move. Expect price. Usually, you might have a supply zone here, and price will test that, and that'll be a 10% move. I have some examples of this, I think. Let me exit this real quick. Yeah, so I have some examples of targets of measured moves. So you can see we have a supply zone, a drop, which is like a 8.58% drop, right? And look at the low. This is the low it made, the initial low it made before it turned around. So it's the first low from the supply zone. And look, price consolidates. It does break it temporarily, retest it a little bit, goes higher. But say you enter here, right? You enter here at the supply zone, your stop above here. Look how precise and perfect that was. That's to the freaking dollar, I'm sure. It reverses, and look at where it goes. Basically, you have on the retest of a supply zone, it comes back to that first initial low it set. So I mean, that was a perfect example. You could see you would have exited right here, and that's a perfect target. That would have been a high R trade. So I think I have another example. You see we have a drop, a base, a drop. This is a supply zone. We had an 8.43% move. This was the low that it created, the first real swing low. Price reversed a little bit. You can see it consolidated, went lower and went higher, retested the supply zone. So you can see my entry would have been here, the bottom of the supply zone. So in this case, like I said, since this supply zone is so small, I mean that's a tiny supply zone, I would place my stop above this wick. Like I said, you still have to take the wicks into consideration. And I know this is an easier example because it's hindsight, and I can see that this wick it wicked above it. But typically, I mean, you kind of have to be crazy to put your stop right above this small, tiny freaking. I mean, that's probably what. Look, this is $200. I mean, that's probably what, $20 or something. I have no idea. But so on this tiny supply zone, I'd put my stop above this. And you can see, what did it do? It came back and barely front run that, but pretty much tapped the first low it made of, after it formed that supply zone. So you can just take this measured move and see how far price is likely to go and get you a good target, because you can see this is the lowest price went and then reversed. So I think I have one more example. Yep, you see we have a demand zone formed after this breakout. Broke market structure, set this high. This is the first swing high it made before price reversed. And you can see on the retest, you enter here, stop below here because a tiny wick, right? I said if it has a small wick, you can place it below the wick. You can place your stop below the wick. So enter here, you could target here, and look. So I guess this one doesn't work out as perfect. You could have taken this, I guess, targeted these highs, but eventually price did break through this and then actually flipped it as support. But this is just an example of how you can take measured moves and pretty much find targets. So as far as I know, I put conclusions. I didn't even write anything here. I'm sorry about that, but that is pretty much all I have for these slides. I hope I covered everything that there is to cover about supply and demand. You know, I'll try to do some write-ups and go a lot more in depth on some of these subtopics, because, you know, there is a lot more. Well, I wouldn't say a lot more, but there's definitely more info and more examples that would be good to look at, so you can get more familiar with them. So that is pretty much it for this this video. Well, I say that I'm actually going to go through a live chart and just mark up some supply and demand zones. I don't know if I'm going to cut this video off right now and start a new one, or like edit it, or if I'm just going to keep it in this video. I'll let you know whenever I post this. But yeah, guys, thank you for watching. I hope this was a good supply and demand video, and I will link all these slides like I said, so you can go back and familiarize yourself with all the topics and not have to watch this long ass video. So let's see how long this video is. Does it say? Yeah, 56 minutes. Yeah, apologies for that. Told you guys it was going to be a long one. But that's it for these slides. So I guess I'm just going to go ahead and hop into this live chart, and we'll go ahead and mark some up. So if you want to watch this part later, go ahead, stop the video, recap on those slides, do whatever. But yeah, we can just go ahead and get into this. So price right now, it's looking, I mean, I'm pretty bullish. Let's go ahead and drop it down to, or drop it to the daily chart. So this demand zone right here, this has been a key zone that I've been waiting for a while now, since we've been up here. Been expecting price to test it again. So, you know, if you take a look at this zone, what do we have? Let's take a look at the odds enhancers. So let me just go back to them so you guys can see them. So how did price leave the level? The stronger the move away from the level, the more out of balance supply and demand are. So let's go ahead and just grade this zone and give it a probability score. So how did price leave the level? Strong up move. I mean, look at these. These are daily candles. You had a break of market structure, a bullish candle. This is a super bullish candle. Look, opened here, didn't go lower, and closed at its high. So that's a super bullish candle, and more bullish candles, and eventually led up here. So I'd give that a 2. I'd definitely give that a 2 on the first odds enhancer. How did price leave the level? So how much time did price spend at the level? The less time spent at the level, the more out of balance supply and demand are. How long did it stay at this level, guys? Not very long. You can see we had a up move, right? The first down day, first consolidation candle, then we went higher. So I'd give that a 2 as well. We did not stay there very long at all. So far we're at a 4. How far did price move away from the level before returning? Your profit margin RR. The farther price moves away, the more reward available. So I mean, you can see this is a huge move away. Mark from this to the high. I mean, almost a 50% move. So if we were to take a measured move from this zone, we'll end up back at these highs. So for that, I'd give that a 2 as well. So right now we're at a 6. So I would be taking this trade. Anything above a 5, remember? Did price break a key level when leaving the zone? If price breaks a key level, that adds significance to the zone. Enough buying or selling at that zone to break a key level. So let's see. Are there any key levels that we can find to the left? So let's see. This is at 9.3. So let's see. I think I had this. Yeah. I think let me go to the weekly chart. Actually, I think this is where the key level is. Yeah, this is the perfect. Let's see, weekly level. So let's see. We have this key weekly level. You can see it was this supply zone, but it's really as resistance. It's just a resistance level. You can see price came up, retested it. These are all weekly candles too. So price retested, rejected, came up, retested, rejected on this candle. So this is a key weekly level for sure. So as you can see, we broke that 10K or near 10K. This high, this was, yeah, so I guess I should mark that out, 10K. That's a psychological level. So I hope you guys enjoy this little process of how I go over it. This is really what I do every time. It's a lot faster whenever I'm doing it without having to explain everything. But so you can see we had this key level. It was resistance, came back up, retested it, broke it, and closed back above it with a little, it's just like a little fake out level. You can see we closed above it, wicked back down, pushed back up, closed it, and then finally broke it. So this is a, that's a key level. We had a 10K psychological level, and then we had that weekly level. So you can see this demand zone basically broke that all of those levels. So did price break a key level when leaving the zone? Absolutely. So that's another point. So far I mean, this is a perfect zone. Do we have levels on top of levels, or levels below levels, I guess, if we're on the buy side on demand? So what do we have? We don't have a demand zone down here that we could see right here, but if you break it down to the weekly, look, we have this demand zone. So do we have levels below a level? We have this level and we have this level. I would mark off just since this weekly level or weekly zone is so big, I would mark off just the top. Alright, that orange is gonna have to do for right now. So we do have levels, or two levels of protection pretty much. You have the demand and then this weekly demand as well, which I just marked off with that one level, because when you get a weekly supply or demand zone, it usually reacts just to the top of it, from what I've seen. So another point, so that is literally a perfect trade. That's 8 out of 8. So this is a perfect demand zone to buy from. And also what you can see is price tapped into it. I think it actually front runned it just a tiny bit. Oh, maybe it didn't. Tapped into it, closed above it, but you can see it came back, tested this bottom of the zone, and then closed above it. So that was confirmation it wanted to go higher. So this is why I was buying spot Bitcoin down here at 9,200, 9,300. And you can see we're getting a good reaction so far. We have this supply zone here. We have a drop, base drop. But with such a key demand zone, I think price is going to break, honestly. And you can see we've kind of already tested this zone quite a bit. We're just consolidating inside of it. And remember, like I said, price wants it, or we want to see price tap into it and close above it or below it. You know, close outside the zone. That's not what happened here. We just closed like a huge bullish candle inside the zone. And really what happened, if you could drop it down a lower time frame, you know, we get this little, we have support, price breaks it, so we have a under over pattern, so use that as support going higher. So that's one reason why that supply zone did not work out very well. You can see it did tap into the supply, but you know, one of those ledges, in this case the ledge was a support level, a daily support level, a daily under over pattern. So it was not a demand zone, but it was a ledge nonetheless. And like I said, price did, it's pretty much the exact example that I was telling you guys earlier. Like price taps into demand or supply. That's once, that's two, that's three, that's four. So it consumes all of these orders. And then finally breaks down, tests the ledge, which is just under over, and then goes higher and breaks that zone. You can see it tested again, and then finally broke and closed above it. So it did, let's see, did it SFP that? Yeah, it did SFP that on the H4. So we'll see if price reverses a little bit here, but that's not the point of this video. It's not an analysis video. But I just wanted to show you guys that perfect daily demand zone. So let's go ahead and just actually shout out to Orkin. I want to tell him that, or just tell you guys in general, he was asking if I could go over like a directional bias, how I get directional bias using supply and demand, and why this is not just a retest, a bearish retest of supply. So you had such a key demand zone down here that we were bouncing from. You know, I got a perfect score on the odds enhancers, you know, probability score. So really, unless it's a super key supply zone up here, it's not going to stop the bullish momentum we get from this daily demand. So now that we hit this very key, perfect probability score, this demand zone, we have a bullish bias. That's pretty much how I go about it. And the reason this bearish retest of supply did not work out is for some of the reasons that I mentioned already, but mainly because of this bullish candle, and we closed inside the zone, a bullish close near the top of the zone. So and now we're just consolidating inside of it. So it's really not looking like it's gonna go farther down, in my opinion. And that's just kind of how I gauge or just a direction and try to pick a daily bias. There are a lot of other things that I use for directional bias, but supply and demand is a part of it. I might just make a whole video on directional bias because there's a lot of other factors that I look at and not just supply and demand. But yeah, let's go ahead and delete some of these levels. And then we'll drop it down to lower time frame and just mark out as many supply and demand zones as I can find and talk about them. Okay, so basically you had this supply zone, right? You had a drop, base, drop, and you can see price did come back up, tested it, and pulled back a little bit. But on the second candle, you could see bullish momentum was so strong from this daily demand that this H1 supply zone is not going to stand a chance. You can see as soon as we closed above it, or inside the zone, excuse me, you could have cut that. That's what I like to do most of the time. Unless you have a really high time frame level, you can see we got a few closes in here. But typically on a lower time frame like the H1 like we have, if you get a close inside the zone, that's a sign that you could exit. You can see as soon as we closed in the zone, it started going higher and flipped the zone. Probably would have got stopped out if you shorted that. So if price does break down, here's the demand zone. This is a huge demand zone. But nonetheless, it is a demand zone. So if price comes back down here, I'll be looking to buy 9.8, and it is my OTE setup as well. You can see price takes out these highs, the demand forms, and then you know, we get this little liquidity gap, void fill, whatever. Price comes up, we have bearish or bullish market structure, excuse me, takes out this high, right? You can see it closed above this, so that's at a higher high. So this is bullish market structure. The fact that this at a higher high gives this higher probability of the range, or not the range, the OTE supply and demand setup to play out, excuse me. So with that bullish market structure, I'll definitely be looking to buy down here. So let's just go ahead and mark out some other levels. So you can see right here, we have a down move before a impulse move that broke market structure over here. So this would be demand. On the odds enhancers and probability score, it would not really not score that high. The reaction away, it was only one candle, one green candle. How did price leave the level? Not that strong, really. I mean, what kind of move was this? So less than a 5% move away from the top of the zone, so not that strong of a move away. How much time did price spend at the zone or at the level? So it didn't spend much time here, but it did spend a lot of time here. So buyers at this level could have been filled. And you can see once price comes back and retests it, it goes up, tests this lower time frame supply, and goes lower. There was not enough buying pressure or unfilled orders here to send price higher. You can see this little consolidation before this move that broke this low. So you can see this consolidation led to the down move that broke this low. Price comes up, retests it, and goes lower. This demand was not strong enough to send price higher. So let's go ahead and look at some other zones. So this is really just kind of, none of these zones are too good. Like you do have a supply zone here. This supply zone, I guess you could mark it out like that. This consolidation led to the down move that broke these lows. So we're breaking market structure. Again, kind of like this, not very strong move away. Not much time spent before retested. Quite a bit of time spent at this level too before it broke down. So really it didn't break a key level. I guess you do have levels on top of levels, so that's a point, but really this wasn't a very good zone to trade from. Here you have a drop, base drop. This you could have shorted. I'm gonna delete that because it's kind of messy. So this is where I guess you could have, actually let me put that back on. If you did take a short from this zone, and you had your level on top of levels, basically could have put your stop above here. How the hell did that curve so much? Alright, whatever. Had your stop up here, and you have two levels to protect you from, and you can see it did come up, test this drop base drop structure, the supply zone, and then go lower. So I guess that could have worked out. It's not typically something I would have traded because it's just not, it didn't look like that very, it didn't look like a very good zone to me. One zone that is nice is this zone. I'll be looking to take profit from any longs up here, maybe flip short. We'll have to see how price comes, and what kind of market structure and momentum we have, but this is a solid supply zone. You can see you had a strong move away, but price is not there yet, so we'll go on. Let's see. So I guess you do have a rally, base rally, rally, base rally. This chart's gonna get real messy. I'm already telling y'all. But basically you had a demand zone, a rally, base rally, another rally, base rally. On this retest, price gave you a little fake out below the zone, but continued to close. So it did close in the zone once right here on this fake out. See, this is one reason why I don't like to leave limit orders, because in certain situations limit orders are the preferred way to go, but most of the time, from what I found, in crypto, especially Bitcoin, it can just get ran through. So this is why, and you would have got stopped out if you placed a limit order here to buy and your stop below here, or even this wick down here, you still would have got stopped out on that fake out. Price moves up a little bit, and you're getting a bunch of fake out wicks under here, but then it started closing above and then went higher. You can see on this demand zone, so much selling pressure. We tapped into it, pushed a little bit higher, and then just kept selling off, closed below it. Let's see. So here we have a good example of a rally-based rally, and I can tell you right now the reason that it failed was because of how much time it spent here, and all of the orders were definitely filled on this consolidation range. So there was really no buy orders to to send price higher at all. Plus, you're getting near a top. I mean, obviously, I guess you can. It's pretty easy to say it's a top after it happened in hindsight like this, but you're getting closer to these resistance levels over here. So that's one reason why that did not work out, is because of the time spent at that level. Here you have a rally, base rally. You can see this rally, base rally, not that much time spent here. Price did decent move away. You had 1, 2, 3, 4, a small down move, then a little bit higher. So I would give that, how did price leave the level? I'd give that a 1. How much time did price spend at the level? I'd give that a 2. Not much time spent at that level. So now we're sitting at 3. How far did price move away from the level before returning? Let's see. From the top of the zone, I would say this is the high, because this was just one down candle, and then this just kind of consolidation, didn't really go down too much, and then higher. So almost 8% move. So I would give that another 1. So 2, 3, 4, sitting at 4. The price break a key level when leaving the zone. It did break this. Let's see. It did break this whole area, these two resistance levels. So I would say it did break a key level, because it broke this high pretty much. This high. So yes, I would say it broke a key level. So that's another point. So I think we're at 5. So that is a tradable zone pretty much, and you would have got, let's see, you would have barely got filled on that one. Let's see, let's see. So this didn't offer the highest R trade, but RR trade, you could have taken some profit here at this tiny supply zone, or you could have aimed for these highs. I probably would have just aimed for this supply zone. Got a 2.2 R trade, not bad. So let's see, and you can see, I guess you did have a drop, base, drop. You can see there's a lot of time spent at this level in general. So price really probably filled all of these unfilled orders. And you can see this ledge right here. Well, I guess you could really just say it's like this SR flip. Whenever it came up here, it did break this market structure. It took out these highs, took out this high. So lower time frame market structure did shift here. Tapped into this pretty unimportant supply zone, because I don't know. A lot of time spent here. And the whole move away wasn't very good. I don't know if it broke any key levels, but you can see it just kind of came back to this support level and then went higher. So really, time at the level before it breaks away is really key, because it really helps you gauge how much or how many of the unfilled orders got filled and whatnot. So we can see here we have a rally base drop. Supply zone, and this would have worked out very well. So not much time spent at the level. Let's just go through the odds enhancers. How did price lead the level? So we had 1, 2, 3, 4. So 4 down candles with pretty bearish candles. This is a strong bearish down candle. So I would give that a 1. Honestly, I'd give that a 1, not a 2. How much time did price spend at the level? Not very much at all. I'd give that a 2. So we're sitting at 3 on the probability score. How far did price move away from the level before returning? So we take the top or the bottom of the zone. So about a 7%. So it's I would say it's good. It's not the best. It is good though. So I'd give that a 1. So we're sitting at 4. The price break a key level. It did break these lows. I would not say it broke a key level. Really, I mean, it broke these lows to break market structure, but it didn't really break any key level. So no. And do you have levels on top of levels, multiple levels? No. Well, let's see. You do have this supply zone, and you do have another supply zone right here. So yeah, you could say you have 2 levels on top of levels. Well, I don't know if you'd count that actually. It has already been consumed whenever price went up here. So again, no, I would say you don't. So that's a 4 on the probability score. So that is typically, I would not trade that. Something to go against what I just said though is the fact that we did have compression. So on the retest, let's see, like I went over. Oh yeah, I guess I drew them out. I didn't have them on here. But anyways, you have compression back to the zone, and that's what you want to see typically, because look, what a price it compressed. Basically, look, this demand zone is the origin of this little impulse. Got consumed on the way back down. I'm just going to mark this out, and it's going to be real messy, but you can see it consumed it. This break, or this breakout, broke market structure. This is a demand zone. Consumed it. You can see just choppy price action. You had this down move before a impulse move that broke this market structure right here. It took out the high, consumed it. So you can see there's really no fresh demand to hold up price. And what did it do? Price just fell through it all. So you know, if you were looking out for that compression, that's a possible short that you could have taken, even though it did not meet the probability score for the odds enhancers. But yeah, so oh man, that's some messy price action. I'm gonna go ahead and delete this daily demand zone because we're not near it anymore. I mean, it's the origin down here, but anyways, yeah. So you can see we have a rally base rally. You would have not got filled on this. Price didn't actually tap into this before it went higher, got front run, so you would have missed that. Let's see. Yeah, see, this is kind of choppy price action. I don't really like these huge wicks. So probably drop this down to lower time frame, because this doesn't, I mean, these dojis, I don't know. I don't want to drop it down a lower time frame and go all the way back, but I'm sure because in these dojis you get like consolidation most of the time. So I mean, it's price pushing up and lower, but you'll get consolidation right at this high, and then it went lower, so it's most likely a supply zone right there. Could have retested it right there. I'm not really going to count that because I don't want to go to lower time frame, it restart me all the way back over there and all that. Here we just have some ranging, or not ranging, some solid uptrend. Not too many demand zones that really stick out to me. Here's one, which I really don't like all these wicks, but it is the origin of a impulse move. You can see these green candles, this is blue, but these bullish candles kind of just build up and then building momentum and then shot up. So that would be a demand zone. You would not have got filled on that, or I wouldn't have. If you included some of these wicks, you might have, but I typically don't like that. So here's a demand zone. Gosh, sorry. Yeah, and this part of the video is going to be a lot a lot longer than the first one, I'm sure. I'm just pretty much going off the top of my head, no script, no notes or anything. I'm just finding any zones that I can see and just kind of talking about them. So if you're here for the scripted part and more structured and organized, this is not really it. This is kind of just free flowing. But this is a solid demand zone. You could see we had this down move that led to the origin, or is the origin of this impulse move that broke these highs over here. So the fact that it broke these highs, bullish market structure. Excuse me, sorry. So we had a strong move away, had a price lead the level, had a strong move away. You can see we had this straight up green candle and then another green candle. So I'd give that a 2. Like if you look at some of these candles over here, smaller candles, and you have this huge impulse. So I'd give that a 2 on how to price lead the level. How much time to price spend at the level? Not very much at all. Just a few candles. You have 2 in this example. We did have some price action over here, but it looks like it didn't affect much. Really, you could see how we started off down here, and then look. This is how supply and demand works. It really is all in this chart. Like this down move that led to this impulse move, basically retested it and then went higher. And look, where did this thing go? Where did price go? Right here, right to this little supply zone. I mean, you can find all these tiny little supply and demand zones everywhere throughout the chart. That's really just how price moves, from supply zone to demand zone to supply zone and back and forth. So let me get back to that. How far did price move away from the level before returning? So we gave this a 2. How much? Yeah, we gave both of these a 2. So we're at a 4. Wait, hold on. How far did price move away from the level? Yeah, sorry, I'm all over the place right now. So we have about a 5% move. So not bad. I will give that a 1. So we're sitting at a 5. So this is a tradable zone. The price break a key level when leaving the zone. If price breaks a key level, then that adds significance to the zone. Let's see. I think this is a. Let's see. Did it break this range high? So range highs, mid range, range low, supply and demand zones, and high time frame levels, like key high time frame levels, like a daily or weekly level. Those are all the key zones that I really look at. Oh shit, I'm on a white background and got a white range, so hold up. So you can see this is the range. So this did take out this range high, it swept it, but no, it didn't really break a key level. So no. And then levels on top of levels, or multiple levels. So we do have this swing low down here. You can put your stop behind that, but really no. So I'll just give this a 5. So that is a tradable level or tradable zone. So let's just go ahead and move on to the next one. So we have this supply zone right here. We see this consolidation. This is a, I guess you could say a rally. I don't know. This is kind of just consolidation. You can mark it 2 different ways. You can mark it here or here. Really do rally, base, drop. Or just say drop, base, drop. In this case, it doesn't really matter because all of the consolidation in this area of price right here, I mean, all of these sell orders would have got filled right here. This is exactly why price broke through it. Just because of how much time price spent there before breaking down, and just filled all of those orders. So you can see we have a base, drop, or excuse me, drop, base, drop. Gosh, I'm talking so much I'm getting confused. But yeah, so we have this supply zone. Price breaks down, retest it, closes outside the zone, retest it, retest it, retest it. Man, there's a bunch of retesting, so all of this supply is getting consumed. So what does price do? It comes back, retest this, just this low down here, and then heads higher and breaks it. So all of these orders were getting filled on all of these different retests. So that's why price eventually broke through it. You could have taken a scalp short though, and this is what I was talking about, ledges. So it broke down, but you have this demand zone. It's a big demand zone, but and it's not very far away from price. So your risk to reward is not very good on this, because I mean it's an immediate price structure that's going to hold it up. So really, this is not a shortable thing, a shortable supply zone, especially if your stop is up here. I mean, your risk to reward is terrible on that. So I hope this is enough, really. I mean, I guess I can go ahead and mark out a few more. I'll go ahead and delete that weekly level that we don't need anymore. So you have this supply zone, this candle before the huge down move. You see price came up, tested it. It did come inside the zone and close, and then broke back down, showed weakness, and then went lower. With these huge wicks, I don't like these zones in particular, but you know, you could have shorted that, I guess. We can go ahead and just run the odds enhancers checklist. How did price lead the level? Very violently. So I'm giving that a 2 immediately. We had these huge bearish candles, so that's a 2. How much time did price spend at the level? See, that's where it gets me. Quite a bit of time was spent at this level. Like if you took this out here, you know, that's a bunch of time that price spent there. So I would give that a 0, honestly. So you're sitting at 2. How far did price move away from the level before returning? Bottom of the zone. That's a almost 9% move, so that's a 2. So we're sitting at 4. The price break a key level. It did break these lows. A key level. Let's see. Yeah, this is probably a key level. This is probably a higher time frame level. So yes, it did break a key level. Let's see. Let's see. So we are at 2, 0, 2. So we're at a 5. So that is a tradable. That is a tradable supply zone. Okay, so we have this demand zone, the origin of this strong impulse move to the upside. So how did price lead the level? Great. I mean, you had this huge impulse move, so that is a 2. How much time did price spend at the level? Quite a bit. Let's see, hold on. So it did break below here and break market structure. So if you wanted to count this, I mean, that's kind of up to you. But I would say it did spend quite a bit of time there. So that is I would give that a 1. Personally, I'd give that a 1. So that is a 3 so far. How far did price move away? 11.5%. So that is very good. So we're sitting at a 5 right now. Did price break a key level when leaving the zone? Yes, that same daily level broke it to the upside. So yes, it did. So that is definitely a tradable demand zone. You can see on the retest would have gave you a perfect entry, and so yeah, I think that's enough for me right now, guys. I could make some more videos on supply and demand and going and marking them and whatnot, but it's getting pretty late, and I know this video is super long already. So yeah, 1 hour and 34 minutes. So I hope you guys enjoyed this video. Please message me if you have any questions about supply and demand. I pretty much exclusively study supply and demand. So yeah, feel free to message me about any questions you have. Hopefully I covered all the topics that you guys needed to go ahead and implement supply and demand and all the different strategies that come along with it into your trading plan and your trading strategy. So yeah, guys, appreciate you guys listening if you stay in for this long. And yeah, see you guys later.